Hey everybody, Smart Silver Stacker here. In today's video, we're going to talk about some of the developments that we've had recently in the world economy as a whole and how they relate to silver and the silver price and silver investments. Specifically, I'm going to get into Evergrande, the Chinese real estate development company that it looks like may be defaulting on its debt. We're also going to talk about the plunge in the price of silver and gold that we saw at the end of last week and what caused that and why I think it's a little bit of a head fake. And so we're going to talk about a lot of interesting stuff in this video, a lot of relevant current events, so stick around. It's going to be a great video. Let's get to it. So what's going on with the price of silver bullion? Well, we're going to get into that in just a moment, but first I want to talk a little bit about Evergrande, the Chinese real estate development company, which may be defaulting on its debt. So this morning we woke up to headlines about the Evergrande default risk, and we've been hearing about that for about a week now. At least that's when I started noticing it in the news cycle. U.S. stock indexes, the S&P 500, the Dow, and the NASDAQ were all down over 1% this morning. The Hong Kong Hang Seng Index was down 3%, so this is not insignificant news. So Evergrande is a multi-billion-dollar real estate development company over in China. It's looking like they may not be able to make the payments on their commercial bonds. They may not be able to pay their debt. They're going to default. This is spooking people. This is spooking investors around the world. The concern is that the debt contagion may spread. It may affect some large banks. At the moment, it's sort of unclear as to who exactly has exposure to Evergrande as an investment. And if they default, I guess we're going to find out. Now, I think that the headlines about this may be a little bit alarmist. I don't necessarily know that this is really going to be China's Lehman Brothers moment, which is how it's being described and characterized in the media. That seems like it's probably unlikely, but it could be the case. This could be the pin that pops the bubble. You never know. The problem with having these enormous financial bubbles like we have in the US at the moment is that they're always looking for a pin. If it isn't Evergrande collapsing that pricks the financial bubble, it'll find some other pin. We found out in 2020 that pins can come in many shapes and sizes. And the problem, I think it's important to remember, is not the pin itself, but it's the fact that we have these enormous bubbles which are so vulnerable to any disruption in the status quo. In a healthy global economy, why would a real estate development company in China defaulting collapse the US stock market, for example? That doesn't make any sense. And it's not just the stock market. If you look at Bitcoin is down over 7% today. So there's all these assets that are in kind of bubble territory. You've got real estate, you've got the stock market, you've got Bitcoin and cryptocurrencies, and they've all been inflated enormously by all of this money creation by the Fed. And now we're worried that a real estate company in China defaulting on its debt is going to collapse everything. So I think that it really just highlights how vulnerable everything, that this is even a problem. Because in a healthy, functioning global economy, what would happen if a real estate development company defaults? Well, its creditors would probably just take its assets and they would auction them off and they would get a portion of whatever they were owed, and that would be it. And those resources then could be allocated efficiently. The market would do a good job of that, and it wouldn't collapse everything, especially not halfway around the world. But the system that we have now, where everybody is indebted up to their eyeballs and there's massive leverage in the system, it really doesn't take much. All it takes is one little pinprick, and that can have reverberations throughout the whole system. And that's because the system really can't sustain any write-offs in assets. If you have Evergrande on your books and all of a sudden that asset is diminished or eliminated in value, you can't sustain that. In fact, most of the markets at the moment, they can't even sustain just stagnation. They have to have constant inputs in the form of fiat currency. And the Fed has been very good about providing that for markets over the past 10 years. Interest rates have been super low. There's tons of easy money available. Just over the past year alone, about 20% of the currency supply has been printed. So I think it's pretty clear that there's lots of money creation going on and that things are extremely vulnerable. But will Evergrande be the pin that pricks the bubble? Who knows? Only time's going to tell. If they actually default, I guess we'll find out. It could also be that these are just headlines geared to grab eyeballs and to be alarmist, because I think we all know that fear sells, and that's nothing new. Now, as far as silver and gold, they really haven't dropped too much today. Silver was down a tiny percentage, and gold was actually slightly up at the open. But the thing that you have to remember is that at the end of last week, gold and silver took a real shellacking in their price. And the reason that we were given for that drawdown in the price of gold and silver and the dropping of value in silver and gold investments was there was a retail sales number that came out, and it was stronger than expected. I believe the sales were up 0.7%, and the original forecast had been a 0.7% decline, so it was a significant beat compared to expectations. And the idea is that investors saw this as a sign of economic recovery, and so they started selling what they view as a monetary safe haven, gold and silver. Now, to me, when you print 20% of your money supply in 1 year, it's not really that surprising that consumer spending goes up, because what we were looking at with that retail sales number was not that people were buying more. It was simply that they were spending more. And I think the explanation that makes a lot more sense is just that prices are higher, and so therefore consumers are spending more total dollars because the dollars are devalued and they're not worth as much. So if you decrease the value of a currency, obviously you're going to have to spend more of it to get the same amount of goods and services. So in an inflationary environment like we have, for consumer spending to increase is sort of a no-brainer. I think it's fairly obvious that that's going to be a consequence of inflating the money supply. But that wasn't how investors in the market interpreted that signal, and so the price of silver and gold got hit. Now, I'm perfectly happy for the market to misinterpret that signal, because it means that I'm able to go out and buy silver at a discount, and anybody out there who's stacking silver can do the same thing. And of course, none of what I provide is financial advice. It's just my thoughts. I'm just a guy on YouTube, so take this for what it's worth. When you see the market and investors get something like that so wrong, when they see more consumer spending in an inflationary environment and they think that this means economic recovery, and the price of bullion drops, well, I view that as nothing but a buying opportunity, and I am always glad for bullion to go on sale, because I don't think any of the fundamentals in regards to gold and silver have really changed. Now, as far as inflation not getting the credit that it deserves for driving up consumer spending, there are some other areas where I think inflation is also not getting the credit that it is due, and that is in all of the shortages that we are seeing. And it's not just in the US, it's around the world in the global economy. We continue to see news stories about shortages and rising prices and supply chain disruptions, but not a single one of these articles talking about rising prices ever seems to cite the money creation. It's always the fact that there's a shortage of something, or that there's a supply chain disruption due to you know what from last year. I don't know. I mean, yeah, supply chain disruptions are real, I'm sure, and there may be shortages of some goods because economies were shut down, so production was lowered for a significant period of time. But when you see prices rising and you only attribute that to supply chain disruptions and shortages, and you're ignoring the elephant in the room of all of the currency that's been created over the past year and a half, 2 years, and really in the past 13 years since 2008, because that is really when the Fed began the currency creation escapades that it's currently engaged in. I really just think you're kind of missing the mark. And I don't necessarily think that it's unintentional that the currency creation doesn't get mentioned. I mean, I think that there really is possibly a concerted effort to rebrand the rising prices that we're experiencing as having to do with anything but the currency creation, because the powers that be, they want to keep the spigot going on the easy money. They don't want to shut that off. And if people began to associate the higher prices that they're paying at the grocery store and at the fuel pump with money creation, they might be a little bit more opposed to all of the money printing. Now, as far as shortages, I mentioned that those are worldwide and they're not just in the US, and they're getting pretty serious. We're seeing an energy crisis now in Europe where natural gas prices have actually tripled. And I read an article the other day where Fatih Birol, so he's the head of the International Energy Agency, and he was blaming the price issues on, surprise, surprise, supply chain issues and also on an unseasonably cold winter. So the cold temperatures have tripled the cost of natural gas. And now, it's not like that doesn't play a role. I'm sure that when temperatures are unusually cold, people do need more energy and more fuel and that sort of thing. But to completely ignore all of the money creation that central banks around the world have been engaged in, when you're talking about something like a tripling in energy prices, I think it's just kind of absurd. I mean, I think it's fairly obvious that when you go on these massive printing sprees, or it should be obvious at least, to someone who doesn't buy into the Keynesian economic nonsense where you can just endlessly create money, the modern monetary theory, I think it should be obvious that the money creation has a lot to do with that. We're going to start seeing these price increases in things like energy. We're going to see them bleed over into other goods and other industries. There's a large bioethanol producer in Germany. It's called Crop Energies AG. And they were saying that higher material costs and energy prices have actually halved their profits. So it's only a matter of time until they start passing on those expenses to the consumer. Now, maybe they bought into the idea that inflation was some transitory phenomenon, and so they haven't raised prices. And I think this goes for businesses across the board because, they don't want to lose market share. They don't necessarily want to raise their prices up, and then if inflation gets under control, they got to drop them all again. I think that when businesses realize that inflation is not the transitory phenomenon that we've been led to believe by people such as Jerome Powell, then they're going to start actually raising those prices, and consumers are really going to start feeling the effects of all of the inflation that's going through the system right now. And it's not just that one isolated company. BASF, Europe's largest chemical producer, and Arubis, which is the largest copper producer over there, they've also made comments that rising energy prices are hurting their profits. So when you start talking about something as big as BASF, they make tons of chemicals, petrochemicals, plastics, pharmaceuticals, all this stuff. You can see how if they start having to raise their prices on these very kind of fundamental items that get consumed in the economy, prices are going to begin rising across the board on all sorts of stuff. And, one thing we haven't seen a shortage in yet is silver. And I think that's good for stackers because we still have the opportunity to be stacking this stuff up at today's low prices, and we still have the opportunity to invest in hard assets and sound money at a very reasonable price. And I really view the pullback as a great opportunity, so I'm going to continue stacking. But I think that once people come to the realization that inflation is not a transitory phenomenon, then these low prices in silver and gold, their days are numbered. Because once people realize that prices are going to continue moving up and that their dollars that they're holding are going to continue losing value, they're going to look for ways to protect their wealth and to protect their purchasing power. And in my opinion, physical silver and gold bullion is the best way to do that, because even paper silver, silver investments, precious metals investments, inflation hedges, whether it be cryptocurrency or any of those things, they're all vulnerable to bail-ins. Just look at what happened in Cyprus during their economic crisis. People who had bank accounts basically just had portions of their bank accounts seized, and there was very little they could do about it. But when you hold your wealth in your hand and you actually take physical possession of it, you're not as vulnerable to that kind of counterparty risk. Nobody else has to hold up their end of the deal for you to have your wealth. You have it right there in your hand. So it's one of the huge advantages of storing wealth in physical metal. You remove it from this crazy inflationary ramshackle fiat system. And, who knows? The system that we have, the financial system, it could keep trucking along for a while. I'm not saying that, tomorrow the dollar is going to collapse and silver is going to go to, $1 million an ounce because the dollar becomes worthless. My point is just that the trend is heading towards inflation. The money creation cannot be stopped because the global financial system clearly is vulnerable, and it's really addicted to easy money, and it's addicted to constant inputs from central banks around the world, constant inputs of fiat currency. So they're going to be creating a lot more of that going forward. And let's say Evergrande is the pin that pricks the bubble, or whatever. It could be anything. I mean, who knows what the next black swan event is going to be that troubles global markets. Well, I think it's fairly obvious what the Fed response is going to be to that, and what the response of central banks around the world is going to be, because it's what they always do whenever there's a financial crisis. They're going to print more money. If we do get a pin that pricks the global debt dollar fiat currency bubble, this is going to be one of the best ways to preserve your wealth and to protect yourself from that event, because they can't print this. You know, the only way you can make more silver is to dig it up out of the ground. You can't press buttons on a computer screen to create it out of nothing like you can with fiat currency. So just ask yourself, where do you want to have your money? Do you want to have it in an asset that can be created endlessly with no effort whatsoever? Or do you want it to be in the world's most useful industrial metal, in a form that cannot be created with ease? It can only be created through the expense of effort and energy and work. And again, like I said, you know, that might be some way in the future, but it might not be also. You know, we're starting to really feel the effects of inflation, despite the concerted campaign to rebrand this as a problem with supply chains and that sort of thing. I think it's pretty obvious that the real problem is with money creation. And that's going to become more obvious to people as time goes by and we really start to feel the effects of this. And one thing is that, you know, the Fed might talk about normalization or tapering, but I think we all know that that's impossible. And it's so impossible that it's to the point where if the Fed even talks about tapering, that can cause markets to drop. You know, they don't have to actually do any tapering. If they come out and they just talk about tapering in the wrong way, or they imply that it's a possibility, then that alone could be sort of a pin to the bubbles that we're experiencing. So if things have progressed to that point where you can't even talk about tapering and you're the Fed, how likely is it that they will really be able to achieve any kind of normalization or tapering or a return to a more hawkish monetary policy? I don't think it's possible. I think that we're just going to see things accelerate from this point on, because things are actually moving along at a pretty good clip right now. We're seeing prices rise in a number of products, and I think that that's going to continue to be the trend. And when the rest of the investors and the investing world and people come to that realization, silver and gold's day will come, and I think we probably are approaching that relatively soon. There's no way to know for sure, of course, when that's going to happen. There's no way to predict what the pin is going to be or when it's going to come or what form it will be in. But you can predict that there will be a pin. And the thing that isn't obvious is the pin, but the thing that is obvious is the bubble. And we are living in a time of enormous bubbles, the biggest financial bubbles that have ever been created in human history. And when the chickens come home to roost, I think it's unfortunate that a lot of people are going to realize that they're holding their wealth in the wrong place. They're holding their wealth in fiat dollar denominated assets, and it's very likely that those may become worthless. Now, you know, it's not like I don't have any cash or any paper assets whatsoever, but I feel a lot safer knowing that at least a portion of my wealth is stored in physical metal, and that's why I'm going to keep stacking. I'm going to take advantage of these dips that we're seeing in the gold and silver market, and I will be stacking higher. So I hope that all of you enjoyed this video. Let me know what you're doing. Let me know what you think about Evergrande. Is it going to crush the system? Is it going to collapse our financial system? Who knows? I would love to hear from you in the comments below, and thank you all very much for watching. I really appreciate anybody who subscribes to the channel. If you enjoyed this video and you'd like to see more videos about investing in gold and silver and precious metals, there will be some popping up on your screen right now that you can check out. So again, thanks very much for watching. Keep stacking, and I will catch you next time. Smart Silver Stacker out.